It's West Coast Wapner today. Let's get to the half.
Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner, live today from the Case Alternatives Conference in Beverly Hills. Investors, as you know, have more opportunity than ever in alts, and over the next hour, you'll hear from some of the biggest players in that space. Jenny Johnson of Franklin Templeton and Glenn August of Oak Hill Advisors. They'll be along in just a bit. Our investment committee with me as well. Shannon Sakosha is here at the Beverly Hilton with me. Josh and Joe are there, as you see, for the hour as well. We're also monitoring Fed Chair Powell because he's going to be speaking this hour as well. We'll bring you the headlines, and you'll hear the Q&A once that begins. We do have a turnaround in the markets, and I think that's where we'll start today. Look at the Dow. It's now positive by almost 0.5%, just shy of that. S&P and the NASDAQ have a little bit of work to do, but nonetheless, the picture looks pretty different than what it did earlier this morning. Shan, I'll begin with you. Thank you to the banks and the industrials, but the bank stocks have turned around. JPM and Goldman on the back of their earnings are not quite positive, but they're well off of what their lows were, and that's helped the market too. The market just needed a little time to wake up to what was pretty good earnings.
Yeah, I think the challenge is, Scott, is the financials have been performing so well over the past couple of months, particularly the banks, and anticipation of yet another strong earnings season. If you look at JP Morgan, for instance, in terms of their guide, typically conservative, and so maybe there were some questions coming into the earnings report. Would this be as good as perhaps people were anticipating? However, what's most important is that we're starting earnings season. That's a huge catalyst for this market. We've been listing a bit over the last couple of days, particularly as China concerns have amplified once again. And so we're at the precipice. You spoke to it, a couple of early industrials, financials, where even before tech comes to the fore, we're likely to see companies besting those expectations because we've come in with very low consensus expectations for this earnings season. And so wouldn't be surprised to necessarily see these beats and see these turnarounds kind of post-earnings calls for many of these companies.
Yeah, Joe, if you look at we can show you again, the intraday moves of the S&P and even the Dow for that matter pretty much track the comeback that we've seen in some of these financials. You own JPM and Goldman, and as I said, though still down, not nearly as bad as they looked early on.
And obviously, Scott, the events of the last several days raise that you need to focus on what's your leverage. What positions do you hold that could be a source of liquidity? So coming into financial earnings, I was very concerned with the significant overweight exposure for Joe T. We heard from Goldman Sachs. We heard from JP Morgan. We're talking about historic trading revenue numbers, fantastic quarters, everything looked great. But as Shannon mentioned, very high expectations. You did hear some commentary from David Solomon and Jamie Dimon that could be interpreted as being somewhat troubling. But I think overall, you look at the financial sector itself, you look at our overweight exposure, and maybe today it's not about JP Morgan and Goldman Sachs. Maybe today it's about others like Fifth Third, like Capital One, like Synchrony, like American Express. It's one of the reasons why I am not troubled or taking action in any of the financial positions we have, because I still think the momentum is there and the fundamentals support it as well.
Stephanie Link today is like, that's why Wells is my largest position in the market, because I know that she was expecting good things, and she certainly got it. That stock's up almost 7%, is Wells. So it's worth noting. Josh, you obviously are in JP Morgan. What do you think about what you heard? As again, that stock looks different now than it did just a couple hours ago.
Yeah, the business is absolutely rock solid. And I think the guidance for next year, net interest income, the consensus was at $100 billion. And they sort of said, we would tell you that $100 billion might be a little bit low. That's music to my ears as a long-term shareholder. I thought the other interesting thing that came up on the call, there were a couple of different analysts who asked questions in different ways about NBFIs or non-bank financial institutions. And maybe that's very relevant to the room that you're sitting in, Judge. But there is increasing concern from the sell side about whether or not there will be an impact at the banks for this boom that we've seen in private credit, direct lending, et cetera, et cetera. This was the first time on the conference call that Jamie barged in and wanted to say something, which I thought was interesting. And what he said was, I probably shouldn't be saying this, but there's never just one cockroach, end quote. So That is an interesting thing. As a JP Morgan shareholder, I don't worry as much about that as I might if I were directly invested into one of the private credit companies, for example, that's public on the market. But I do think that'll be like the big risk in the fourth quarter is if people get nervous about the First Brand situation, or there are others, or the bank's adequately reserved, et cetera, et cetera. That's pretty much the only risk I can really come up with at this point. So outside of that, if capital markets hold up, I think this sector remains bid. Companies like JP Morgan that are considered to be the safest houses, I think will hold up the best. And I want you guys to put up a quick chart of BlackRock, because this is a name that we talked about. It's on the best stocks in the market list. It's on the verge of a big breakout. Not intraday, guys. Give me like a year, please. All right. Take a look at this stock. It's about to take out the historic highs from a few weeks ago. When I listened to that call this morning, there was nothing that told me that this is a business that is seeing deceleration anywhere. They're doing revenue in crypto, in cash management, in fixed income, in obviously equities globally. It's $13.5 trillion in AUM around the world. And I feel like if the markets stay as healthy as they have been, this is a very obvious way to capitalize on it.
Look, this is going to be what you were referencing with credit, a hot topic at this case conference today. I'm certainly going to be talking with Jenny Johnson in a little bit about it. Glenn August, obviously, about it from Oak Hill Advisors, to see what they think and what the overall tone and tenor is in the rooms here at this event about what's transpired in the credit market and the private loan market to date, and whether there is legitimate reason to be concerned about that. It's worth noting, too, that some of the alts managers, which have been really under the microscope as the market has been concerned, are rebounding quite nicely today, almost across the board. Apollo and Ares and KKR, Blue Owl, for example, 2%, 3%, 4% gains. So we'll get into more of the alts story in just a little bit. I want to continue to focus on the market, though, because you had the presidential social media post on Friday, which really upset everything, and then a bit of damage control, if you will, over the weekend. And here we are still asking ourselves the question of whether there's a bubble in this market around AI and elsewhere. What's interesting to note today, Bank of America's latest fund manager survey, sentiment is the most bullish that it's been since February. Investors are overweight stocks the most since that time as well, while at the same time, 54% think AI stocks are in a bubble. Josh was mentioning some of the commentary that you got from Jamie Dimon. Well, he and David Solomon of Goldman Sachs were both talking about the idea of a bubble, whether they believe there is one or not. For Jamie's part, he said, quote, "We have a lot of assets out there which look like they're entering bubble territory. That doesn't mean they don't have 20% to go. It's just one more cause of concern." That feels a little bit of PTJ-ish, right? Paul Tudor Jones last week. Yeah, things look similar to what they did, years ago, but that doesn't mean that we're not going substantially higher from here. David Solomon, for his part, said, quote, "There's no question that there's a fair amount of investor exuberance at the moment. But as students of history, we know that following periods of broad-based excitement around new technologies, there will ultimately be a divergence where some ventures thrive and others falter." So it's a topic. It's going to be one here today, too. We'll ask our special guests throughout the day what they think about that. But, Shan, what do you think?
Well, I think the questions they bear worth asking, and they probably bear worth answering, but they probably can't be answered today. I think our challenge right now is that there has been a significant amount of money that's been poured into AI at the front end of this and enablement. And if you think about the potential for CapEx to continue into 2026, that's fundamental to our thesis that economic growth will continue. But, Scott, those have and have-nots, that has to start to expand beyond the tech sector. We have to be able to see companies outside of technology implementing these types of innovations in order to create greater productivity and enhance margin. That is going to be well beyond what we've done with ChatGPT so far. And so I think the real question is, do we get that reinvestment, that investment in innovation outside of these tech companies? Do we get that in time where we potentially lap that sort of decline or deterioration in CapEx at the hyperscalers? They're not going to be able to continue to spend the way that they've been spending over the last couple of years forever. And so what you need to see is need to see that baton being moved to these other companies. And so I think that's where the question is like, are we going to see companies get confident enough in 2026 with lower rates, with deregulation, with some of these tailwinds to start to put forth that CapEx in order to sop up what we believe is important to continue this economic growth?
Joe, maybe you're just going to be in a more volatile environment around the mega caps until you hear from them during earnings season, which is not going to come for a couple of weeks. You're just going to have to wait to hear from a lot of these names, which have certainly been more volatile of late. Obviously, the NASDAQ got blown out on Friday. It had a nice rebound yesterday. Look, Alphabet's positive now. Some of the chip names like AMD are in the green, but NVIDIA's down 3.25% or so. You're just going to have to be patient, I think.
I think, first of all, what Friday was a very stark reminder to all of us to look at what you hold in your positions and say to yourself, what's your leverage on your positions, and can your positions be used as a source of liquidity? It's interesting because all year people come on the network and they talk about owning quality. Well, guess what? This hasn't been a quality rally in 2025. This has been a momentum rally. This has been a crypto rally. This has been an AI adjacent rally. And in some areas of the market, it's a junk rally. And yesterday was kind of evidence to that. Today, we're making a little bit of a turn. So what do you do with all of that? I think you say to yourself, look at the positions that I have. And maybe as it relates to AI, we know that OpenAI is touching all areas of technology and the semiconductors and various parts of the economy. Maybe I'm not throwing any more money at that. Maybe this is the right moment to step back and say, okay, I'm long. Everyone else is long. Let's sit tight on that. Maybe it's an opportunity to look at some other areas of the market where you could rotate capital accordingly, like some areas of healthcare, like some areas of the financials, like some areas of the market that have been unappealing so far 2025. And I think in doing so, you're kind of reshaping your risk.
Yeah. Well, speaking of alts, which is the topic obviously here in Beverly Hills, they're booming. You know that. Case is a platform, by the way, that connects some of the world's largest alternative asset managers with investment advisors, and there are many here. Robert Frank joining us now to go inside this investing phenomenon. Robert?
Scott, great to see you. And as you say, alts are booming. They're also one of the most misunderstood, confusing, and complicated segments of investing right now. Now, the term alternatives refers to basically anything that's not a publicly traded stock or bond. So that's private equity, it's private credit, it's hedge funds, it's venture capital, it's real estate, it's gold, it's crypto, it's art, all the other collectibles. Now, if you look at where this has been popular, the wealthy have been adding to their exposure to alts for decades. So it, like I said, typical U.S. family office has about half of their investments right now in alternatives, about 25% in private equity, 20% in real estate, all the rest in those other asset classes. Now, the theory is that alts generate higher returns and lower volatility in exchange for lower liquidity. But by many measures, the median returns for private equity, for instance, have lagged public markets in both the short and the long term. Now, family offices have actually been adding to their public stocks recently, due mainly to AI. And since they can't get money out of private equity, they're putting less money into private equity. But now that IPOs and exits are coming back, those returns for PE may improve. The amount of capital going into private equity has increased by tenfold since the financial crisis. And the total investments right now in all alts expected to hit $29 trillion, Scott, in just 5 years. That would be double what it was in 2022.
Wow. It speaks to, it's really great setup there for us, Robert. It speaks to why we now have an Inside Alts newsletter with Robert Frank. I urge everybody to check that out. Some of the world's largest asset managers are here at the CASE conference. They want to make their products more accessible to you, to retail, to investors like all of you. Leslie Picker joining us now with more on that side of the story. Following the money as always, Leslie.
Hey, Scott. Yeah, call it the retail revolution or the democratization of alt. It's one of the biggest untapped markets for asset managers right now. You just heard Robert Frank give those statistics about how fast the industry is growing. Well, retail investors' allocations to private capital are projected to grow from $80 billion today to about $2.4 trillion in the United States by 2030. That's according to Deloitte, which defines retail here as those deemed non-accredited by financial regulators. That includes individuals with net worth under $1 million, excluding their primary residence. There are several different types of vehicles that give retail investors more liquidity than a traditional alternative asset fund. However, usually these come with extra layers of fees relative to institutional funds. And Moody's recently warned that these funds designed for retail, while growing in popularity, could create broader risks for the U.S. economy due to some of the illiquidity concerns there. Full coverage from myself and Robert Frank, of course, can be found in that monthly newsletter that you mentioned. You can subscribe using the QR code on your screen to the right there, Scott.
Yes. It's a dynamic duo, you and Robert, and Inside Alts. And I urge everybody to check that out, really, if you want the inside scoop. Leslie, thank you so much. The bottom line is that the 60-40 portfolio has changed so dramatically. It says everything to me that your firm and, your NB Private Wealth, that you guys are here. You want a piece of this action.
Yeah, I mean, I think at Neuberger, what we think about, Scott, and actually what we've done for clients for many years is think about this as a continuum. Private equity and private credit are just part of your equity and fixed income allocations. And increasingly, they're a big part of that universe. If you think about the decline in public companies that are listed, if you think about the increase in those private credit, I mean, we've seen loan growth decline significantly since 2010 for traditional financial institutions. And so in order to create a larger investable universe and really capture the full universe of equity and credit, you need to have allocations within private markets. And so I think it's a little bit less about thinking about this as an alternative and more about thinking about on that continuum, if you are especially with a longer term time horizon, you can put some of these assets into these aspirational categories that can grow over time.
Okay. Welcome back. We are live today in Beverly Hills from the Case Alternative Summit. The bankruptcies of two companies in the auto sector have heightened concerns around certain parts of the credit market. Glenn August is founder and CEO of Oakville Advisors and joins us now here at Case. It's good to see you.
Good to see you.
So you do business in many parts of credit, right? Private credit, leveraged loans.
Yep.
Last year at this conference, I sat here asking people if there was a bubble in private credit. I think it's relevant now to ask you whether we're starting to see the first cracks in that whole story.
I do not see a bubble in private credit. The companies, yes, there's isolated instances. You refer to a couple of bankruptcies. There's always idiosyncratic credit risk. But if you look at where the economy is, if you look at where the equity markets are today, if you look at the balance of where we are from inflation, growth, et cetera, I'd say the backdrop is still reasonably solid, but that's not to say there's not risks in the market. I love Jamie Dimon's comment today that if there's one cockroach, there's probably more.
I was literally going to ask you about that, okay? Because you said idiosyncratic. He suggests maybe not so much.
Well, again, idiosyncratic is a question of how many cockroaches are there. Okay, so if we look at the market today, in the leveraged loan market, in the high yield market, there's less than 5% of credit trading below 80. Generally less than 10% trading below 90. There's really idiosyncratic risk. And where's that coming from? There's issues with some companies that are impacted by tariffs. If you're importing tools from China, guess what? You have higher costs today. Okay, there's impacts of AI. Some companies are challenged on their premise, will AI make them less relevant? Some companies can use AI. And then interest rates have been higher, so costs have been higher. The subprime consumer has been challenged. So there's credit risk. But what I think about is that the credit market is not the equity market. In the equity market, the Mag 7 is 35-40%. In the credit market, there's hundreds and hundreds of companies.
Much deeper.
Each one of them has their own story. And so for people like us who pick credit and have been picking credit for decades, we still see good opportunity, and I don't see a private credit bubble. I don't see a bubble in our markets. That's not to say there can't be a few extra cockroaches around. There'll be alleged fraud from time to time. There'll be cyclical challenges, but by and large, there's still good opportunity in this space.
So a few other cockroaches around is different than this being a canary in the coal mine?
That's what I think. And again, as I've been doing this for almost 40 years, you need to really have distress, you need a recession and you need forced sellers. And today, I don't see a recession anytime soon. And the markets have evolved such that the credit markets there's not forced sellers. There's not that much mark-to-market leverage in the system. The bank loan market is CLOs. The high-yield market is over 50% double B. The private credit market is all bilateral negotiations. So I think there's good opportunity as private equity starts to deploy more capital. There's really good opportunity to deploy capital. There's good opportunity for the wealth channel. I saw your previous interview. And again, it does not make sense for individual investors not to have the exposure to alts.
What do you make of this today from Bank of America's fund manager survey? 57% of respondents said private equity, private credit is the most likely source of a systemic credit event, the highest conviction on the source of such a disruption since 2022.
I have looked at that survey for years and normally take the other side of the survey. In my view, what I would say on private equity is that I think returns will be lower. It is more competitive. Interest costs are higher. And I don't think private equity will deliver the returns, which is why so many of our investors are allocating capital from private equity to private credit. I don't see it.
So let's take it from the angle of you obviously aren't too concerned by what you can see. The whole nature of the shadow banking system is what you can't see because it's so opaque. So how do we truly know what is hidden in various places out there that we won't know about until it starts to get really heated up?
There's so much talking about the shadow banking system, but let's put in perspective. When we do senior direct lending and get paid 8 or 9% unlevered, we occasionally, for some of our accounts and funds, will lever that 1-to-1 or 1.5-to-1. That's not 10-to-1 in the banking system. The companies that we're lending to are more than 50% equity cushion. And so again, I think this whole fear is overblown. It's held by long-term capital. We have 8 of the top 10 sovereign wealth funds, 15 of the top 20 largest U.S. pension plans. They are long-term investors, and they can take that illiquidity premium. And so, again, I don't want to say that there's not risk. There is credit risk always. That's why you get paid 8, 9, 10%, or in special sits 10, 11, 12, or higher. You're taking credit risk, you're taking liquidity risk. But that doesn't mean there's a canary in the coal mine and that we're heading towards it.
Lastly, has this forced you, though, to look in your own book and just go over it once, twice, and 10 times?
We look at our own book every day. Nothing has forced us. We've been looking at our own book every day for 38 years. So the answer is you always have to be on top of what you own every single day.
Glenn, it's great to see you. Thanks for being here with us. It's Glenn August of Oak Hill. Chair Powell is taking questions now at the annual NABE meeting. We'll go to that live.
States of affairs for our two variables, our two goal variables, call for different monetary policy responses. So, yeah, as they come more into balance, I think the idea has been that policy should move from being, tight to some degree to being more neutral as those two things balance out. But it is clear, though, that if we move too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. And if we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two things. I think for the last few months, we've been able to maintain a restrictive stance because the labor market was still pretty solid. I think that the data we got right after the July meeting showed that, which adjusted back all the way through May, showed that the labor market has actually softened pretty considerably and puts us in a situation where the two risks are closer to being in balance.
Hello, everybody. Welcome to Blue Cloud Trading. I am George, and I've got a special guest here today. He wanted to come on. He wanted to say a few things. Sir, go ahead. You get the mic. Hello, everybody. Yes, it's me, Donald J. Trump. I've got a few things I want to say. If you haven't liked or subscribed to this channel, it's time to do it. You gotta do it, okay? It's just the way it is. Melania's gonna be very upset if you don't. So let's get started. George, why don't you go ahead and continue with your technical analysis. By the way, I love Ichimoku. Nobody loves Ichimoku more than I do, okay? All right, guys. Take it away, George. Thank you, sir. Thank you. Appreciate you. All right, so let's get into this. And I appreciate the support. Very important. Guys, we just saw a few clips from today's episode of the Halftime Report. It is Tuesday, October 14th. It's currently 3:37 p.m. and as you can see, the market is still moving. Do you see that little red candle that just moved? It's still moving. Yeah. So right now, as we speak, the Dow is up 0.53%. NASDAQ is actually down 0.45%. The S&P 500 is down 0.04. Russell 2000 is up 1.57%. So we'll keep an eye on this. We'll, as I'm doing my analysis here, we'll take a look and see what's happening towards the end as well. Let's look at the heat map real quick and see what's happening regarding the individual stocks in the S&P 500. Nvidia down, Broadcom down, JP Morgan down 2%, Amazon down 1.81, Tesla's down, Meta. A lot of the healthcare stocks are down. Consumer defenses did pretty well today. Industrials, utilities, okay, basic materials. Let's take a look at the sectors real quick. Here they are. Let me zoom in a little bit. There we go. And you can see that consumer defenses are up 1.56%, followed by industrials, financials, and real estate, and utilities. Technology down 1.19%. All right, now what we're going to do is take a look at the actual stocks they talked about on the halftime report. So here's a list of some of them right there, like JP Morgan, Goldman Sachs, BlackRock. We're going to look at those. We're going to start off, though, with the S&P 500 ETF, the SPY, the QQQ, the Dow, the Russell 2000. Then we'll look at 3 of the Mag 7s, Tesla, Apple, Meta. And we'll then go into the strongest sectors, all right? And I might do a few more here from the ones that aren't so looking that great. But we'll start off with the strongest. And by the way, if you notice that there's a blue flag right here on the left, that means that these ETFs are strong on 2 time frames as far as the technicals are concerned. They look good on the weekly and the daily time frame. That's how they earn that little blue flag. What we're using here is the Ichimoku indicator. It's a great indicator. It's a Japanese indicator. It's I know it looks a little bit busy. There's a lot of things going on here, a lot of lines. But with that said, you get the Senko Span A. That's the upper part, the light colored blue line right there. That's part of the cloud, the Ichimoku cloud. You got the Senko Span B. That's also part of the cloud. These are derived. It's a mathematical formula. You take the midpoint of the 2 moving averages right here and project that 26 periods in the future. And the purple line that you see right there is actually the midpoint of the last 52 periods here. And that, instead of being projected under, like these moving averages are, it's projected 26 periods into the future. Then you've got your green line, which is the 9 period. That's the midpoint of the last 9 periods. The red line is the midpoint of the last 26 periods. So it's a little slower. We always want that green line to be above the red line. We always want the Senko Span A to be above the Senko Span B. And one final aspect of this is that white line that you see right there. That's the Chiku Span. That's the current price, okay, in a line form that's projected 26 periods into the past. So we're covering the past, the future, and where we currently are. And the idea is to see where that white line is in relation to the candle 26 periods ago. If that white line is above the candle 26 periods ago, as it is here, that's very bullish. In this case, this is First Solar that we're looking at right now as a stock. Everything looks in order on the weekly chart. Let's take a look at the daily chart. Is that also in order? Well, today it's not. So as you can see, 3 days in a row where it's under the Tenkan-sen. So it's showing the majority of the elements are in effect, is basically they're looking very bullish, but for the last 3 days, it's been showing a little bit of bearishness. All right. So that's how you can kind of get a quick synopsis and a quick picture, really, of what is happening with any of these stocks and ETFs that we're going to go into. So let's take a look at the S&P 500. And here we are. So now what's going on with the S&P 500? Actually, it's going to lose. You can see here in the daily chart, when I looked at this earlier, we were above the Tenkan-sen, folks. It's just right now it's dropping 0.14%. Let's take a look at that 1 minute chart. Oh yeah, look at that big drop now towards the end of the day. This just started happening. So you can see here 3:28 p.m. and it started dropping precipitously in this large candle. What time did that happen? 3:38 p.m. Some event must have triggered this, obviously, and now the S&P 500 is dropping a little bit. It's only down 0.22%, as you can see. So let's look at the weekly chart. Still very strong, holding up above the moving averages and the cloud on the daily chart. However, it just lost its blue flag. So Bye-bye. How about the Qs? QQQ ETF. That too earlier had a blue flag. It is now back in between the two moving averages. It's still a relatively strong place to be, but as I've mentioned, I also like to use other indicators in addition to the Ichimoku, like the directional movement index, for example. And what this is telling me, I've got this at a setting of 9, which is different. And I also have the ADX 9 superimposed here on top of this. That's one of the cool things that you can do with this platform. It's called TC2000. If I wanted to put this on top of the chart here, I could actually do that. I'll just trigger it. I'll show you guys what I'm talking about. Boom. All right, I can make another. I think you can even place it up here maybe. Yeah, anywhere you want to, basically. You just drag it and leave it. And there it is. So that way you can save some space on your charts if you want to put more indicators on a specific chart. But basically, this isn't looking particularly great here with a directional movement index. We're getting a different picture here. What you see is the negative DI, which is the red line there, is above the green line, and the ADX is moving up. What basically triggered this change here of the red line crossing above the green line was this day here, Friday, right? That big red down day. Right now, here's the situation that we're currently in. We are basically in this box based on this large candle. And so as long as price is staying within this area, we're good. If it starts to drop under the low, and especially if it gets under this 583.32 level, that could be kind of really negative, because now we're going to potentially break through these levels of support here, and that's not good. It's also going to test the cloud as well. These are levels of support right here. As long as we stay above the cloud, we're bullish. When we're under, like we were over here back in, you can see here back in March and April, right? We were under. You generally don't want to be adding new positions when you're under. You want to wait for the immersion. You want to wait for the catalyst. The catalyst is when price breaks above the cloud. We now know that, okay, things are looking sunnier, basically, after they've been under for a little while. So, yeah, I'd be watching that 583.32 level as we go. And right now, I mean, we're still, like I said, it's down 0.86%. Let's look at this on a 1-minute chart. Yeah, it's just dropping as we speak. Here we can see 3:44 p.m., 57 seconds, dropping. I really wasn't expecting that. It's just happening. Let's look at the Russell 2000. Interesting how the Russell 2000 seems to be the strongest today, right? Up 1.3. It's changing, of course, but it's above the moving averages. It looks like it's going to actually close above this 244.46 level. All right. We still have 15 minutes left in the trading day, so we'll see what happens. The VIX itself, all right, this is the thing that I was a little bit concerned about, because Friday we had this big spike right here. We went from a level of around 16 up to a level of around 21, and at one point we were up at around 22, right? Today we actually reached 23, and then it dropped. But look where it stalled. It stalled right at the moving averages and the 200-day moving average, which is this dotted yellow line, okay? The 200. So I don't know. I don't know what's going to happen here. And I also don't like the fact that the VIX we want to be dropping. It's actually bullish for the market because it represents volatility and fear. We want that to be dropping. We don't want that to be spiking like it did back in April, as I've mentioned before. This is back in April. Boom, and you can see that big jump. It reached a level of $60.11 in early April, and after that it kind of dropped, of course, when the market started going up. Let's look at FEZ. Now this one is the Eurostoxx 50 ETF. It's up 0.55%. Here's the daily chart. We are in between the two moving averages, so there's no true direction here quite yet. I mean, overall we're bullish because we are still above the cloud, but it is stalling in this area. All right, let's get into the rest of these stocks now. The stocks they talked about on the show, JP Morgan. Now, I had a position in this one. I shared my trades with members. So, if you're a Blue Cloud Legend level member, you're going to see my daily trades, and I post them on YouTube. Let me show you guys where I do that. So once you click the join button here on my YouTube channel, you'll see the different levels. You select Blue Cloud Legend, you hit the join button. You can also get other perks from the Blue Cloud Trader, like the exclusive member-only videos, but you won't see those daily trades here. Or if you want to support this channel, become a Blue Cloud supporter so I can keep making these videos for you guys. One more thing I wanted to mention is that once you do select and become a member and you've hit that join button, a new tab will actually pop up right next to posts. It will look like this right here, and that's where you'll find those posts. And if you scroll down, you can find the different member-only videos, that I've posted for months and months now. Anyway, guys, let's get back to what we're talking about. It is currently 3:51 p.m. and let's do a quick check on the market real quick here. I want to see what's going on here. Boom, boom. All right. Okay. So it seems to be stabilizing around this time, which is good. All right, that's good. That's good news. So yeah, JP Morgan, I mean, it came into the Ichimoku cloud here, and then it's now seems to be moving back up again, which is good. Let's look at the 1-minute chart. Yeah, it seems to be stabilizing, creating a little bit of consolidation area right here. All right, so yeah, I closed the position for 7.2% profit. It has dropped a little bit since then. How about Goldman Sachs? Now this one here, let's see, it's in a downward channel right now. We do have a bullish spinning top candle that's formed here, but the problem with this chart is the fact that actually this one should not have a flag, because the Tenkan-sen, it looks like when it got triggered, it got under the Kijun-sen with that big drop down. So we're going to get rid of that flag there. So I would hold off on Goldman Sachs, guys. In fact, I would wait until it breaks through that trend line that you see right there. It's a downward channel right now, so I would not be adding that one. And let's see, Wells Fargo. This one here popped. It was up 6.82%. Looks pretty bullish overall on the daily chart. The Tenkan-sen, the green line, the faster one, is still under the Kijun-sen, so I'd hold off on this one though. But it should start to show some strength pretty soon. Here's the weekly chart. It does look pretty good on the weekly overall. Get Apollo Asset Management. Now this one I would stay out of this, because obviously it's under the Ichimoku cloud. You don't want to be testing this one with a long position. Why? Because you don't know if this thing is gonna, is this the end of this trend? We don't know. The bottom line is it's sort of embedded right now in a downward channel. Okay, and so when that's the case, you want to hold off and wait for evidence, right? This is an evidence-based approach that we're looking for. So the evidence is the cloud itself. If it can break through that, then you've got potential for another move up. Right now, you can see back here, this is when price broke above the Ichimoku cloud, and it just kept on moving up to this high on December 6th of 2024. I'm sorry, December 13th of 2024. I mean, in 1.6 years, it went up 185%. Since that date, if we measure from that point to where we currently are, all right, we're down about 32.1%. I can see that in the little box that just populated down here. So, and what the other thing that you want to also pay attention to is what's going on here. We're basically in a downward, potentially downward channel. We got a lower high here from the prior high. And if we take out this low here, it should find some support around this area. This is also going to probably, at the same time that it finds this low, it's also going to be getting close to the 200-day that's rising. And maybe that might be a better buy signal. Maybe by then, you might have to wait a little while though, because it still needs to break through that Ichimoku cloud. Notice also how the cloud itself is bearish. So it gives us a little bit of insight about what's the future kind of looks like a little bit, right? Senkou Span A is currently under the Senkou Span B, where over here the Senkou Span A was above the Senkou Span B. This is where the crossover took place, right? We would have seen this crossover 26 periods into the past. So it kind of gave us a little sign that, hey, things aren't looking that great for Apollo Asset Management. PSP. This one here seems to be stalling quite a bit now at these high levels here. You can see that level right there. Has not been able to take that out. We've got a lower low here from the prior low and this low as well. So I would, that low right there. And so I'd hold off on PSP. On the weekly chart, we're still under the Tenkan-sen, the 9 period. And on the daily chart, we're under the cloud. All right, we did recover a little bit. You're up 0.93%. but it is still under the cloud and under, yeah. And by the way, check out the Chico span. Remember I said earlier, if the white line is under the candles, that's bearish. Cloud is also bearish. So you got a lot of signals here from Ichimoku. We're getting multiple signals. You should not be adding positions here. You want to use traditional analysis? You can certainly do that as well. Let's take a look at this low right here. It just got taken out, right? So it got to, that's not good. So I'd hold off on PSB. All right, let's take a look now at Tesla. What's going on with Tesla? And like I said, we'll get back to looking at the indices in a second because it's 3:56 p.m. right now. Tesla has pulled back a little bit. It's in between the two moving averages. It's down 1.76%. So on the daily chart, I would not, it's not giving us a buy signal here for sure. If you look closely, you'll notice that the red line is above the green line. That's also bearish. On the weekly chart, it does look more bullish though, right? So it's, but it seems to be stalling in this area. How about Apple? On the weekly chart, you can see it's currently above the moving averages here, right? We've got a future bullish cloud. That's good. But the problem is without, in the past, when we reached that 260.10 level from over here back in 2020, is that 2024? I think so. Let's see. Yeah, December 27th, 2024. When we reached that level, let me fix this, sorry. Price basically dropped. We came back to that same exact level, the 260.10 level. And what happened? Now this is a weekly chart we're looking at. This is last week, big drop. So it's currently under that 250 level as well, based on that prior candle. I'd hold off on Apple. It's not giving us anything positive here on the daily chart. We're under the Tenkan currently for 4 days. All right, and we've got it's very clear that the negative DI is above the positive DI. What about Meta? Look at this one. This looks even worse, honestly. If you look at what's happening here, we got under the Ichimoku cloud here. That's very bearish, okay, on the daily chart. And there's a downward slope right there from that high to that high. There's a downward slope going on. And if you look at the weekly chart, for about 4 weeks, we've been under the midpoint of the last 9 periods, right? So that's sort of also a very strong indicator. I mean, we could certainly change, things could change, but right now it's not the time to be adding, in my opinion, humble opinion. All right, let's keep going. All right, so now we're going to look at some of the sectors, guys. So let's start off with the strongest ones. And at the time that I reviewed these a little bit earlier, these were still looking good. So let's see if they still are holding up. Silver, yes. Even though silver SLV is down 1.12%, if you look closely, all of the elements of the Ichimoku are very bullish. We get the bullish cloud here with single span A above single span B, the green line above the red line. The Chico span is way above price. Silver has been on a tear for a long time, has not even broken through the under the Tenkan since this little candle here, which is back in September 18th of 2025. It's just continued to move up. Everything started getting really bullish with silver all the way back here where it broke through the cloud. Okay, so there's some evidence for you. It's up 56%, over 56% since it broke the cloud. All right, XLI today broke above the Tenkan and Kijun. Cloud is bullish. It's just, you know, there seems to be, it's not like an ultra bullish looking chart. When the cloud, by the way, there's a lot that the cloud can tell us, all right? If it's going flat like it is right here, even though it is slightly higher than the single span A is slightly higher than the single span B, it's not really something super bullish. Like the thicker the cloud is, right, as you see here, the stronger the trend is too. Right now, we're currently still in the consolidation stage. Do you see what's going on right there? See how price is kind of stuck in that range? But if we break through these highs here, that's going to be huge. That's when you can see a big expansion for the industrials. So maybe I would hold off a little bit, right, on this ETF. SMH dropped. SMH dropped 1.86% today, and where yesterday it was above the Tenkan, today it's under. Let's look at the weekly chart. You know, we just saw Nvidia a few seconds ago that was down. So here is down 1.86% on the weekly chart. On the weekly chart, I mean, overall the chart itself is still very strong. So when you look at the long-term charts like the weekly, and that's important, the the big picture is telling us, hey, this thing is still in effect, right? We're still obviously still moving upwards, and the cloud itself is still looking good. With daily chart, yeah, we got a little bit of weakness here. This candle is what triggered the red line to cross above the green line. So we got to see if this is going, what's going to happen here. It almost looks to me like a pattern. If you just draw like a pattern right there, it's almost like a symmetrical triangle right there. Which way is it going to go in the next few days? Will it go to the top? Will it pop, or will it drop? All right, we'll see. Utilities. XLU on the other hand. Now I like this. Here's the daily chart. Start off the weekly, very bullish. Daily chart, beautiful. It's broken through this little resistance area. You can see that it looks like it's going to close above it. In fact, it did close. It's 4 p.m. right now as we speak. All right, so it closed above, up 0.89% for the day. I like it. Utilities looks very strong. GLD, gold, up 0.78%, also very strong. Look at this, guys. Here's another example of how fantastic this indicator is. Notice how price sometimes comes right down to it, touches it, and then bounces. Right here, bounced off of that level, bounced off of that level, that level, that level, that level right there. It literally touched the Tenkan-sen and then moved up. Why is that? Is it magic? No, it's not. It's basically a lot of people are using this indicator. There's a lot of financial institutions using this indicator. And because it's giving us an average, that's why these moving averages sometimes will go flat, like you see right here. If you're just looking at a 50-day moving average, it's going to be sort of smooth. It's going to look a little bit like this ADX right here. It doesn't really flatten out much. It just kind of, but when these moving averages, they go flat, they actually become a much stronger level of support. Like right here, you can see how it flattened out. Over here, you can see it flattened out. Over here, flattened out, and then it bounced off of it. Right here, flattened out, bounced, okay? GDXJ, Gold Miners ETF. Okay, interesting. This is interesting, I gotta say, because I've been watching this 105.24 level for a little while now. Let's see. I mean, this is all-time highs, the 105.24, and it can't seem to get through it, the Junior Gold Miners ETF. If it does break through, I think we're going to see a big expansion for the Junior Gold Miners. The green line is still above the red line. Everything still looks good, but we seem to be stalling right here. Okay. Now the rest of these ETFs not looking. I mean, some of them might be okay, but there's something technically off about them, which is why they didn't get a blue flag. I'll just kind of skip through these really quickly. Like Oil K, for example, is the ProShares K1 free crude oil strategy ETF. You can see it's under the cloud and still dropping, down 1.61. Copper today, the Copper Miners ETF dropped today. It was up above the Tenkan-sen yesterday. Today it got under, down 3.12%. XLC is still under the Tenkan-sen for multiple days now. That's the communication services sector. Bitcoin, down 2.89%. IBIT, it's under the cloud. Real estate, under the Ichimoku cloud and the 200-day moving average, but it's up 0.95% for today. Consumer discretionary is under the two moving averages right there, but it's above the cloud, so you don't have all the elements, right? And if you look closely, you'll also notice that the Chico span over here is underpriced. That's also bearish, but the cloud is still bullish. So you can have multiple things, you can have multiple signals, and when you have different, when they're not all telling you the same picture or the same story, you can't really trust it as much, obviously, right? It means that there's a little bit of weakness there, and I certainly wouldn't be adding new positions in a situation like that. Look for the optimal entry. You'll have a higher success ratio with your trades. XLV, healthcare, up 0.27%. It's in between the two moving averages. That's why it didn't get a flag. XLP, under the cloud, no on that one. That's consumer staples. XLK, today down 1.32%. Yesterday it crossed back above the Tenkan-sen. Today it's staying in between the two moving averages. Interesting. XLF, financials, broke above temporarily, but then came right back down under the 26 period, that flat level. Like I said, so if price happens to be under, like it was here, and it comes back to that level, remember, when that moving average flattens out like this, if price is underneath, it becomes a level of resistance, And so now it was unable to successfully close above that level, right? Even though it was up 1.1%, that wick represents the high of the day, but then the closing price is the body, right there. So it closed underneath. And we can see that selling that took place at the end of the day here by looking at a 3-minute chart. There it is. Okay. It got under on the 3-minute chart. This is what it looked like this afternoon between 2 p.m. It was around 2 p.m. where we hit the highs, and then it started dropping. All right, let's keep going. Energy on the daily chart, currently under the cloud and under the 200-day. XHB is under the cloud, home builders. XLB, materials, is under the cloud, so know on that. That's going to do it for this video, guys. I hope you enjoyed it. Don't forget to like. Don't forget to subscribe. Really important to do that. And if you like this video, share it with someone, especially since you got to hear my Donald Trump impression today. You got to do it. You got to do it, folks. I'm telling you. You really do. It's so true. And like I said before, Barron, Melania, they're all going to be upset if you don't do it. So you got to do it. Thank you. All right. Have a good one, guys.